Hello again, BinaryAuctions.com here. We are continuing with our second part on how to avoid rookie mistakes, and we said in the first part that the first thing to consider is that one needs to understand what moves the financial product or the financial product that you choose to trade, be it a currency pair, be an index, or being an individual stock or commodities. You got to know what moves, what are the economic releases that are influencing that product, and when they are being released. The next thing to consider is try to avoid as much as possible short-term expiration dates. I mean, consider binary options trading. Well, binary options trading goes with 70%, 75%, even more percent rate of return. Now, if you look at the banking industry, the rate of return that you will get for a 1-year deposit, and then you look for the rate of return that these brokers are offering for something like 60 minutes expiration date, then you gotta be realistic and put this into perspective. The only way to beat this game is to avoid as much as possible short-term expiration days. From my point of view, 60 seconds, I don't know, trying to eliminate as much as possible the randomness, and therefore trade bigger expiration dates. It doesn't mean that you are trading less. It means that you give your analysis a bit more time until it comes to fruition. For example, daily, weekly, and monthly expiration dates are recommended. Why? Or why waiting for 1 month for the option to expire? Well, first of all, you are not waiting for 1 month, because if you trade it on the second half of the month and you are waiting only for a couple of weeks, or maybe even less. Weekly, you are not waiting for 1 week, because if you trade on Thursday, for example, you wait only for 1 day and a half. But in this way, you will have the opportunity to trade more on the technical part and to avoid big economic events like non-farm payrolls in the United States, when market is moving like crazy, like press conferences after central banks' interest rate decisions, like a press conference after the ECB European Central Bank meeting, a press conference after the FOMC statement, or a press conference after the Reserve Bank of Australia statement. And you can avoid that, or those spikes or volatility, with a bigger expiration date. So that is a thing to consider. Another mistake is to divide your portfolio or to divide your investment. In other words, it all starts with the size of your trading account. Well, if your trading account, for example, is $1,000 or euros or whatever it is, then it doesn't make any sense to go and trade one option with $100, because with 10 options then you are wiped out. You may be right 10 out of 10, but it will be only out of randomness. You gotta spread the risk. Spread the risk not only through different options or into different options, but spread the risk through different expiration dates, spread the risk with different amounts, and also spread the risk with different assets to be traded. If your broker offers currency pairs, indices, individual indexes, individual stock or commodities, trade proportionate. If you want to trade in 1 week $100, then you divide that $100 into 3 different parts: currencies, indices and stocks, and commodities. And then the amount that results, you are dividing it in the currency pairs that you want to trade based on the economic calendar and based on the news that are supposed to come. Then you choose the expiration days based on end of day, end of week, and even end of month. And you will see that it will be really difficult that the account is going to be blown up, because just following these simple steps, you will be ahead of the game. Here on Binary Options Academy, on thirdbinaryoptions.com, we still do have some money management advices and educational projects. So make sure you check them and make sure you understand what it means. Thank you and have a great day.